Matter of fact, 3.99%. That is a real 6-month HELOC promotion available in August of 2026, and a $30,000 draw at that rate costs about $100 a month in interest. Cheap money apparently, except your first year rate is not 3.99%. If the promotion expires after 6 billing cycles and the remaining 6 months cost roughly the current national average of 7.44%, your blended interest rate is about 5.72%. Add realistic setup costs, and the benefit you need from that $30,000 can rise to somewhere between 6.7 and 10.7% in year 1. That is the line we need to find. The point where borrowing against your house stops beating, leaving the equity alone. The offer itself is straightforward. The lender fixes the annual percentage rate at 3.99% for 6 billing cycles. Afterward, the rate becomes variable, usually based on the prime rate plus a margin determined by your credit, your loan-to-value ratio, and the terms of the line. The disclosure also sets a floor, a ceiling, and any minimum draw. So the advertised number is real. It is also temporary. Bankrate's late July survey put the average HELOC rate at 7.44% for a $30,000 line, a 7 to 100 credit score, and an 80% combined loan-to-value ratio. For context, Freddie Mac reported a 6.69% average conventional 30-year mortgage rate in early August. Those are different products, but the comparison tells you something useful. Ordinary HELOC money currently costs more than ordinary first mortgage money. Your promotion therefore creates 2 rate periods. During the first half year, $30,000 multiplied by 3.99%, then divided by 2, produces about $599 of interest. During the second half year, the same balance at 7.44% costs about $1,116. Add them, and your first year interest is roughly $1,715. Divide that by $30,000, and you get 5.72%. Brief pause. That is your first corrected number, not 3.99, 5.72. And it still is not your break-even line, because that calculation has priced the interest while pretending the account appeared for free. Some HELOC offers cover most ordinary closing costs. Others charge origination, appraisal, title, recording, annual, inactivity, conversion, or early closure costs. A fee may be based on the approved credit line rather than the amount you draw, which matters if you open a $100,000 line and borrow only $30,000. A lender may also waive costs on the condition that you keep the account open for several years, then recover them if you close early. Use the actual disclosure, not an average, but we can build a planning range. If total setup costs equal 1% of your $30,000 draw, that is $300, your first year cost becomes $2,015, or about 6.7%. If setup costs reach 5%, that adds $1,500. The total becomes $3,215, or about 10.7%. That range comes before any annual charge or early closure fee. There is an even faster test. Paying 7.44% for the full year would cost $2,232. The 6-month promotion saves about $518. A fee above roughly 1.7% of the draw consumes that entire promotional saving. The HELOC might remain useful, but the teaser has stopped doing financial work for you. By the way, subscribing helps Lazy Investor keep doing this kind of housing math, so I appreciate everyone who chooses to do it. Time can rescue part of the deal because a one-time fee becomes less important when spread across several years. Keep the same $30,000 balance for 4 years. Assume, only for illustration, that the rate remains 7.44% after the first 6 months. That is not a forecast. It gives us a clean benchmark. The promotional half year costs $599. The next 3.5 years cost about $7,812. Total interest is roughly $8,411. Add the $300 setup case, divide by $30,000, then divide by 4 years. Your transparent cash cost hurdle is about 7.3% per year. With $1,500 of setup cost, it is about 8.3%. Duration diluted the fee, but it also replaced almost all of the promotional period with variable rate debt. Annual charges and applicable closure costs would move both numbers higher. A rate increase would do the same. So a 4-year break-even claim can be reasonable, but it does not mean 4 years makes the money cheap. It means you have finally spread the opening costs far enough that the ongoing rate dominates the calculation. The payment structure now becomes more important than the opening fee. During a typical draw period, often around 10 years, many HELOCs allow interest-only minimum payments. At 7.44%, your $30,000 balance produces about $186 of monthly interest. That feels manageable. You pay $186. Preserve the $30,000 for the renovation or investment, and keep the line available for future draws. 12 months later, however, you still owe $30,000. 5 years later, if you have paid only interest, you still owe $30,000. The payment rented the lender's money. It did not buy back any of your equity. You can voluntarily pay principal during the draw period, and many disciplined borrowers do. But then the relevant payment is not the low minimum shown in the initial comparison. It is the amount required to eliminate the balance on your intended schedule. If you want $30,000 gone in 4 years at an unchanged 7.44%, the amortizing payment is roughly $725 a month. That cash flow commitment tells a very different story from $186. The difference lands even harder when the draw period ends. New borrowing stops, principal repayment begins, and the remaining balance is amortized over the contractual repayment term. One lender illustration shows a payment moving from roughly $250 during the draw period to about $555 in repayment. That is not a universal increase. The result depends on the balance, rate, and remaining term. It demonstrates the mechanism. A small early payment can become more than twice as large because deferred principal has entered the bill. More seriously, if that transition occurs near retirement, the HELOC has changed the income your portfolio must support. The house did not suddenly become more expensive. The decision to turn equity into debt created a scheduled claim on future cash flow. The line is also conditional liquidity. The Consumer Financial Protection Bureau explains that a lender may freeze additional draws if your financial circumstances change or if the lender reasonably believes you may be unable to repay. Credit limits can also be reduced under permitted conditions. That does not make a HELOC defective. It means an unused line is not the same asset as cash in your account. The moment when you most want emergency credit may also be the moment when your income or property value makes the lender less comfortable extending it. Taxes appear to lower the hurdle, but only after the destination of the money passes a specific test. Current Internal Revenue Service guidance says interest on a home equity loan or line may be deductible when the proceeds are used to buy, build, or substantially improve the qualified home, securing the debt. You generally must itemize, and applicable mortgage debt limits still matter. Use the line to replace your original mortgage, buy index funds, pay living expenses, or take a vacation, and the interest does not automatically become deductible merely because your house secures the loan. A kitchen renovation may qualify. New furniture for that kitchen generally does not perform the same tax function. Even when the interest qualifies, a deduction is not reimbursement. If $1,000 of deductible interest reduces your tax by $240, you still spent $760 after the tax effect. And if you take the standard deduction, the incremental federal benefit may be zero. Your tax position changes the hurdle, but your accountant has to apply the rule to your property, debt, and use. The loan brochure cannot determine that from the rate alone. Slows down. Up to this point, we have been asking how much the HELOC costs. That is only half the decision. A HELOC does not make your home equity earn a return. Your house appreciates or depreciates based on the property and local market, whether you borrow $30,000 or leave it unencumbered. Borrowing adds cash and an equal liability. Net wealth does not rise at the moment of the draw. The funded use has to create the benefit. That benefit might be a predictable cost you avoid, a necessary repair, a substantial improvement, replacement of more expensive debt, or an uncertain investment return. Ordinary consumption can provide real lifestyle value too, but it does not generate a financial return that offsets interest. Now, the central question changes. You are not choosing whether 7.44% sounds low. You are deciding whether the thing purchased with the $30,000 can conservatively beat the complete cost of financing it. Suppose a seductive answer is investing. Fidelity calculates that the S&P 500 returned an annualized 10.4% during the 30 years through 2025, close to its longer historical average of roughly 10%. Subtract a 7.44% borrowing rate, and the apparent spread is about 2.6 percentage points. On $30,000, that is roughly $780 a year before setup costs, taxes, fund expenses, or changes in the HELOC rate. The first year, $300 setup case cuts that expected spread to about $480. A $1,500 setup cost wipes it out and leaves you behind, even if the market delivers the historical average on schedule. The larger problem is not the average. Your interest obligation arrives monthly. Market returns arrive irregularly. A portfolio can fall 20% while your borrowing rate rises, leaving you with a $6,000 paper loss, the full $30,000 debt, and no permission to wait if household cash flow breaks. A 10% historical average is evidence about a long series of market outcomes. It is not a promised one-year return, and is not equivalent to the certain contractual cost of debt secured by your home. That thin spread becomes less appealing late in your career because sequence matters. If you must sell investments after a decline to make payments, the loss is no longer temporary from your household's point of view. A more dependable use can clear the line. Replacing debt that genuinely costs 20% with debt near 7 or 8% creates a large arithmetic saving, assuming you stop rebuilding the expensive balance. Yet you have also moved an unsecured obligation onto the house. The rate improved while the collateral consequence became more severe. A necessary repair can protect the home from greater damage. Replacing a failing roof may prevent water intrusion, even if the roof does not add dollar-for-dollar resale value. The benefit is partly an avoided loss and partly continued shelter. That can be rational without pretending the project generated a 10% investment return. A renovation is harder. $30,000 spent on a kitchen may improve your daily life and possibly raise the property's value, but resale studies rarely support assuming every dollar returns as immediate equity. If the financial value is $20,000 and the remaining $10,000 is lifestyle value, call it that. Do not ask the spreadsheet to certify a preference. Using a HELOC to send a lump sum to your first mortgage has even less mystery. You reduced one loan balance by creating another balance. Any genuine acceleration comes from the extra household cash used to repay debt, not from moving the debt between accounts. If your mortgage accepts additional principal without penalty, the same surplus can go there without adding a variable second lien. Once the use survives that test, the product comparison becomes easier. A home equity loan gives you a lump sum, commonly at a fixed rate, with principal repayment beginning immediately. Bankrate's late July averages for a $30,000 loan were about 8.08% for 5 years, 8.22% for 10 years, and 8.20% for 15 years. Those posted rates are higher than the average HELOC rate. But if your expense is known, your holding period is long, and a changing payment would damage your retirement plan, the extra rate can purchase certainty. Your balance declines on schedule, the payment does not depend on prime moving favorably, and there is no draw period reset waiting later. The HELOC has the advantage when the need arrives in uncertain stages. A renovation paid across 18 months may not require borrowing all $30,000 on day one. Interest applies only to what you draw, and repaid capacity can become available again if the line remains open. That flexibility has value. It should be compared with the fixed loan certainty, not treated as a free bonus. Cash-out refinancing creates another attractive headline. Recent conventional refinance rates have been around the high 6% range, which can look cheaper than either second lien choice. But a cash-out refinance does not finance only the new $30,000. It replaces your existing first mortgage with a larger one, adds closing costs, and may restart the term. Take an illustrative homeowner who owes $250,000 at 3.5%. Rough annual interest on that existing balance is $8,750. At a separate $30,000 home equity loan near 8.1%, and the combined rough interest is about $11,180 before fees and amortization. Refinance the full $280,000, near 6.9%, and rough first-year interest approaches $19,300. The lower headline rate on the cash-out product became far more expensive because it repriced a much larger balance. If your existing mortgage were above the new refinance rate, the result could reverse. The correct test is the new mortgage's total interest and costs against the retained mortgage, plus the separate borrowing option over the years you expect to keep the loan. Monthly payment alone cannot answer it because extending the term can lower the payment while raising lifetime interest. And then there's the option that receives no promotional rate. Do not borrow. Federal Reserve household data placed owners' real estate equity near $34.9 trillion in early 2026. A separate ICE measure covering mortgage holders reported about $18 trillion of equity, including roughly $11.7 trillion considered tappable while preserving an approximately 20% cushion. That is an enormous reservoir of potential collateral. It is not an instruction to extract it. Leaving equity alone preserves cash flow, borrowing capacity, and housing stability. The home continues providing shelter. Its price still changes with the local market. You have not missed an investment return generated by the HELOC because the HELOC generates no return. You have declined to attach a required payment to your house. For someone approaching retirement, that can be a valuable allocation decision rather than financial laziness. A quick side note, if this kind of cold comparison is useful, subscribing makes a real difference to the channel, and I'm grateful when you do. The final routing test begins with your actual holding period. If you expect to repay the $30,000 within 1 year, blend every rate period and add all costs triggered by opening and closing the line. In our representative case, that base hurdle is already about 6.7 to 10.7% before annual fees, early closure charges, tax effects, and a margin for risk. If you will carry the balance for 4 years, the simplified interest plus setup hurdle is about 7.3 to 8.3% per year under an unchanged rate assumption. Rate variability, account charges, and collateral risk still sit above that line. Then examine the benefit. A contractually avoided interest cost is more dependable than an estimated renovation payoff. An estimated renovation payoff is more dependable than a 1-year stock return. Lifestyle value can matter greatly, but it should not be labeled investment profit. Your repayment source has to survive as well. A bonus you expect is not cash received. A future refinance is not guaranteed. An unused line may not remain available through a job loss. If the plan works only when rates fall, markets rise, and your employment continues without interruption, the benefit does not clear the hurdle conservatively. For a short, staged expense with a credible repayment source, a HELOC can be the best fit. For a known lump sum held over many years, the fixed home equity loan may win despite its higher opening rate. A cash-out refinance survives only when repricing the entire mortgage improves the whole loan result after costs and term changes. If the use cannot produce a sufficiently reliable benefit, the winning financing structure is no financing structure. Quietly, the collateral deserves an explicit margin too. A 7.5% expected benefit does not adequately compensate you for a 7.44% variable obligation secured by the home. The mathematical spread exists, but the household spread is too thin to absorb a fee, a rate change, a delayed payoff, or 1 bad year. You choose the safety margin based on how stable the benefit and repayment source are. The more uncertain the benefit, the wider that margin needs to be. False precision here would be comforting and useless. The opportunity cost belongs in the same equation. If you already have cash earning 4% after tax, borrowing at an all-in 8% to preserve that cash creates a negative 4-point carry, though retaining liquidity may still have personal value. If paying cash would empty the emergency reserve, the HELOC may buy flexibility worth more than that spread. The economic cost and the liquidity benefit must remain separate. And remember what has not changed: the property. Borrowing $30,000 does not surrender future appreciation, and refusing the loan does not cause the equity to sit outside the housing market. The equity is already exposed to the house. The HELOC adds leverage and spendable cash, then charges you for both. The house is either a wealth decision or a lifestyle decision, pretending it's both, is how the math breaks. Firmly cheap money ends, where the conservative after-tax benefit of the funded use fails to clear interest, setup costs, recurring charges, repayment risk, opportunity cost, and a meaningful safety margin. For this $30,000 draw, that line begins around 6.7 to 10.7% in year one, or roughly 7.3 to 8.3% over 4 years under our stated assumptions. 3.99% is the price of the invitation. Your complete household hurdle decides whether borrowing the $30,000 beats leaving the house unencumbered.